Hey, so we all have opinions on where the market is going, right? A hunch about a stock, a feeling about the economy. But how does a simple idea like that transform into a real, professionally managed trade? Well, today, we're going to break that down. We're looking at the anatomy of turning a view into a venture.
So it really all starts with this one basic question. What's the actual difference between just having an opinion and, putting real money behind it? The answer is a lot deeper than you might think, and it really gets to the core of what professional risk-taking is all about.
And there it is. According to our source material, if you can't clearly state what would prove your idea wrong, your position isn't really a trade. It's just this, a gamble that you've dressed up in some fancy analysis. A good story without a solid structure? That's one of the most dangerous things you can have in your portfolio.
Okay, so let's get into the first big step in this journey, making that leap from just being an observer to actually being a participant. This is the moment where all the theory and ideas, they collide head-on with financial reality. And believe me, the stakes get very real very fast.
You know, what's so fascinating here is the huge mental shift that has to happen. The second you put capital on the line, the question changes. It's no longer just, hey, what's probably going to happen? Instead, it becomes a calculation of expectancy. You're forced to ask, okay, how much can I win if I'm right versus how much do I stand to lose if I'm wrong? It stops being about being right and starts being about managing the consequences of being wrong. So, how do you even survive that jump from watching to doing? Well, you definitely can't rely on just a good story. You need a structured thesis. And you should think of this less like a casual hunch and more like a detailed architectural blueprint, one that's specifically designed to survive the chaos and randomness of the market. And that blueprint? It's got 5 parts that you absolutely cannot skip. First, the dominant driver. What is the one big thing moving the price? Second, quantitative anchors. What are the hard numbers that frame this trade? Then you got to assess the overall risk environment, account for market plumbing or structural risks. And finally, you look for similar situations in the past, your historical analogs. If your thesis is missing even one of these, it's probably way too fragile.
And this really gets to the heart of it. Anybody can have an opinion. I mean, they're everywhere and they're free. But building a real structure around that opinion, that's what creates actual value. That's what gives you resilience when things get messy.
And this is just a brilliant way to put it. Saying something is cheap is just a feeling, an opinion. But saying it's trading in the 10th percentile of its 5-year range, now that is a measurable, data-driven fact. That is your quantitative anchor, and it's the rock-solid foundation of a professional thesis. Okay, so let's say you've built this amazing, robust thesis, you're feeling good. But hold on, not every great idea is a good trade, at least not right away. Before a single dollar gets committed, that idea has to pass what our source calls the tradability gate. Think of it as a final, intense interrogation.
This is like your pre-flight checklist, and there are 3 absolutely critical questions. 1, what specifically would prove this entire thesis wrong? If you don't have a clear answer, you're not ready. 2, how much of this idea is based on hard facts versus just a really compelling story you're telling yourself? And number 3, you have to conduct what's called a pre-mortem.
And this is that pre-mortem. You literally force yourself to imagine total catastrophic failure. Picture it. It's a month from now, the trade is a disaster. Now write the story of why it failed. What went wrong? Did some hidden factor pop up? Did a government change a policy? It's an incredibly powerful exercise because it forces you to find all the hidden weak spots in your idea before it's too late. Which brings us to a really important point that's going to come up again and again. The goal here isn't to build a system that never, ever loses money. That's a fantasy. The goal is to build a process where your losses are controlled, where they're understood, and most importantly, where they're survivable. Losing is just a normal part of doing business. All right, so the thesis survived the interrogation. Now it's time to enter the arena. This is all about execution. It's about how you actually express your idea in the market, and maybe even more crucial, how you decide how much risk to take. So choosing your weapon, this is a huge part of the strategy. Are you making a simple up or down bet with futures? Are you trying to play a relationship between two things using spreads? Or if your timing is a bit fuzzy, maybe you use options. They give you what's called convexity, which is just a fancy way of saying your potential upside can be way bigger than your predetermined downside. The tool you pick totally shapes the risk and reward of the trade. And then we've got sizing.
This chart nails a core discipline called volatility targeting. It's simple. When the market gets choppier and more volatile, your position size has to get smaller. It's an inverse relationship. And look, this isn't about being scared. It's smart. It's about making sure one crazy market swing doesn't knock you out of the game for good. And all of this really points to one fundamental truth. Your sizing is your number one defense. Your long-term profit and loss, your P&L, it isn't built on being some perfect fortune teller. It's built on your ability to survive your own mistakes and the market's complete randomness. So we've talked all about the external stuff, the thesis, the execution, but now we get to the final piece of the puzzle, managing what is probably the biggest risk of all, the one that's inside your own head. This is all about the professional's mindset. Yeah, the minute you have skin in the game, your brain starts playing tricks on you. Suddenly, you're fighting these invisible enemies. You're looking only for news that agrees with you. That's confirmation bias. You're sticking with a loser just because you've already lost so much. That's sunk cost bias. Or you're convinced the last few days of price action tell you everything about the future. That's recency bias. Professionals know this. They build external systems like keeping a detailed journal to force themselves to be objective when their own brain is screaming at them to do something emotional. And so we come back to this central idea, one last time because it is so important. Losing money on a trade is not a sign that you failed. It's just a statistical reality of a business that is all about probabilities. A professional accepts this, they manage it, and they never tie their self-worth to the outcome of any single trade. And when you put it all together, this is what the whole transformation is about. It's about becoming this kind of person, someone who puts on risk with clarity, with discipline, with resilience, because they understand their real job isn't to see the future. It's to manage the odds right here in the present. So I'll just leave you with this one last thing to think about. The next time you feel that powerful sense of conviction about something, a stock, an idea, anything, just stop and ask yourself this question. Is that feeling built on a solid, well-thought-out structure? Or have you just fallen in love with a really good story? Honestly, the answer to that question makes all the difference in the world.